Hi, I'm Adrian. Welcome back to Premium Logic Lab. Software stocks sold off hard, and the dominant explanation is simple. AI is coming for software. But simple explanations are usually incomplete. So today I want to answer 3 questions. Who is Anthropic, and why did a release from them move global markets? Is AI actually going to dominate the software stack? And most importantly, was this sell-off justified, or was it a narrative-driven overshoot? Let's start with what the news is saying. A big part of the sell-off was tied to Anthropic launching new workplace tools and plugins, including legal productivity tools, and that reignited fear that AI can automate workflows that software companies currently monetize. That fear spread globally. Even IT services names sold off because if AI automates routine knowledge work, parts of outsourcing get pressured too. But then you also had industry leaders pushing back, calling this reaction premature, basically micro-hysteria, because enterprise AI adoption at scale takes time. So which is it? Here's the framework. The market wasn't just reacting to a tool. It was repricing a possibility. That AI becomes the interface layer between a user and the work. If that happens, the value of software shifts from clicking around a UI to describing an outcome and letting an agent execute it. That is the threat. Now, who is Anthropic? Anthropic is one of the major AI labs behind the Claude model family, founded by former OpenAI researchers and positioned heavily around enterprise safety, reliability, and steerability. Whether you think Claude is the best model is almost beside the point. Because model quality is only one part of dominance. The bigger part is distribution and workflow integration. Who ships inside the tools enterprises already use? Who has the trust and compliance posture? Who can be embedded into daily workflows? That's how winners emerge. Now, is the sell-off justified? My opinion is partially. Here's the rational part. Some software categories really are vulnerable. If your product is basically summarizing, drafting, cleaning data, writing simple queries, generating basic marketing assets, or automating routine business logic, then you're exposed because AI can turn features into commodities. And if your moat is thin, your multiple deserves to be lower. That's rational. But here's the reflexive part. Markets often move faster than adoption. A tool announcement can reprice uncertainty instantly, even though the business impact takes quarters or years to show up. Enterprise budgets are sticky. Integrations are hard. Compliance is slow. So when the market dumps everything, it's often not a precise forecast. It's a risk reset. This is also where the comparison to the DeepSeek moment becomes useful. DeepSeek triggered a sharp sell-off in Nvidia and tech because investors feared it could change the competitive regime in AI and threaten pricing power across the stack. And what happened after? The market eventually cooled down and started separating what was a real structural risk from what was just a narrative shock. This is important because we may see the same pattern here. A narrative shock hits first, then the market does the real work, differentiation. So what's the real differentiator going forward? It's not AI good or AI bad. It's this. Does the company own distribution, data access, and workflow control? Companies that own the workflow or become the workflow can survive and even grow. Companies that are basically a set of features with little switching cost are in danger. So how does this pan out? Here are my scenarios. Scenario 1, the market overreacted. AI disruption is real, but adoption is gradual. Multiples stabilize, and best-in-class software rebounds first. I put that at around 40%. Scenario 2, the sell-off is the beginning of real margin compression. AI adoption accelerates, buyers consolidate tools, and weaker SaaS categories lose pricing power. I put that around 35%. Scenario 3, the market chops sideways and leadership changes. The sector doesn't collapse, but it becomes more volatile and more selective, less beta. More dispersion. I put that at about 25%. None of those are certainties. But that's the point. The goal isn't certainty. The goal is to respond with the right mental model. If you're watching this as a trader or investor, here's the key takeaway. This wasn't a software is dead moment. It was a reminder that when a sector is priced for perfection, uncertainty gets repriced violently. AI is a genuine structural force, but markets always compress the timeline. They price 24 months of disruption in 24 hours, and then reality shows up. That's why probability matters. If you want, in the next video, I can explain how to interpret this through options and volatility. Because volatility doesn't just measure fear. It measures disagreement about the future. And disagreement is what creates opportunity and risk. Thanks for being here.